All right, now we're on. All right, hello everybody. This is the Trader Continuum live broadcast. I'm Wes Walton.
I'm Gordon Scott.
Man, we're getting better at that.
Getting better.
And we're finishing each other's sentences. That's just awesome. Okay, today we have a special broadcast, a special presentation that we call 5 Trading Myths that will what do we call it? That will wreck your account. Yeah. Now, granted, we were being a little bit dramatic. Those were my words. Will wreck your account. They won't necessarily wreck your account, but it can cause a lot of problems, or it can cause a lot of confusion. And gosh, it sure does make trading more difficult when we are following these old wives' tales of sorts.
Yeah. I wouldn't classify your words as being overly dramatic necessarily. I mean, any of these held on to long enough, I have watched each of these wreck a trading account. I mean, you see a lot of things when you coach 1,000 people to learn how to trade. And I can tell you, these myths have done damage. Now, hopefully, none of our astute watchers and listeners have had that experience recently anyway. But I'll bet that if you look deeper into the statements we're going to make, you're going to find that there are a couple of your own beliefs that are probably worth challenging. And that is the hope from this, is that if you're listening, you're going to say, I should think about my trading differently, at least a little bit in this area. And by doing so, your trading will become more productive. Because if you're making more money, we're being more happy. That's it.
I like that. Now, we're not going to be showing screens during this presentation, or at least not very often. During the presentation part, during our 5 myths part, we'll just be talking directly to you. So you're not going to see us switching screens and stuff like that. Now, when we get to a little bit more market analysis type stuff, we'll be doing just a little bit of that at the end, and we may be sharing some screens. But just figured I'd throw that out there as a formatting issue. That way you don't think that...
Did you just tell them they have to watch us for 40 minutes and be bored?
I didn't say 40 minutes. This presentation doesn't have to last any longer than 5 minutes. In fact, if you leave right now, you don't have to watch it all. So,
but then you won't get the benefits, so we'll be succinct and hopefully entertaining as we go through.
Yeah, we can only hope so. Okay, so myth number 1.
The markets are not random. That's myth number 1, that the markets are not random.
So the myth is they're not random, so you're saying that they are random. The markets are random.
So this is carefully worded. I am not trying to say that the markets are definitely random. I'm saying it is a myth that they are not. Now, there is a subtle difference, sort of a gray area in between these two statements that most people are unaware of. But it goes like this. If you think to yourself, well, the markets aren't random, I need to trade in those ways that show very clearly that if you do this, you get that, and it gets gain, and so I'm just looking for these things that automatically provide profit. Well, the problem is that the markets are not based on automatic behavior. Now, in fact, the more and more algorithmic the markets become, the more potential there is for automatically inefficient behavior to occur. And so that's actually good news for people who trade humanly, or more importantly, people who like to mess with algorithmic trading. But that's really kind of a subtlety. The deeper reality is that markets are constantly shifting. And they're constantly shifting because they're run by people. They're not run by machines. Even the algorithms, even the robots and so forth, are ideas that people have put into the machines. So it isn't the case that people are going to do the exact same thing every day. Some people are going to do the same thing most of the time, and then all of a sudden they won't, right? So there are 4 exits in a crowded theater, and the theater is packed, and somebody jumps up and says, "There's a fire in the building," fire in a crowded theater, right?
Yeah.
And everybody heads predictably to those 4 exits, whatever one they deem to be closer that they can get to fastest, right? Yeah. That's a simple prediction, but it's not 100% accurate. It's not going to happen that way all the time. Why? Well, because one of the exits might be blocked. And so the other three exits are where everybody's going to head to. And if you're just blindly saying, well, I know this exit right behind me is closest, so I'm just going to turn around and go, oh my gosh, it's blocked. What am I going to do? You know, you're stuck. You're the last one out of the theater and you're burning.
Yeah. Or alternatively, for me, especially, like, I'm sorry, but I'm not running to an exit. I'm just sitting there and then turning around and looking around and making sure I'm not about to be on fire. Because, I mean, what if you start running toward the exit and there is a fire? I mean, what if the fire is at that exit? So I'd rather look around and assess the situation.
You're actually demonstrating my point.
Well, I know.
You look around and want to assess the situation, but so does everybody. Everybody assumes that everyone else is going to act out of panic. Now, there will be times where some people act out of panic, but even in dire circumstances, most people don't act out of panic. They might act quickly. They might act in ways that aren't necessarily logical because, you know, that split-second decision-making may help them make an illogical decision. You know, we see evidence of that. But, like, a crowded stadium, you know, if all of a sudden everybody wants to get out, they're not just going to be blindly trampling each other. I was amazed once when I was, okay, this is a funny story. I was amazed once when I was 17 years old, and I went to a concert for the Dead Kennedys. I don't know if you know. Yeah. I mean, I don't look like that type. Trust me. It was San Francisco. It was the Haight-Ashbury district in the 1980s, and all the hippies were gone, and so it wasn't the drug place anymore. It was now the punk rock place. And imagine me with spiked hair and, you know, eyeliner and stuff. And okay, yeah. Crazy days gone by. Meanwhile, we go to this concert, right? And there, what at the time was called slam dancing, and where, you know, you're just basically, now it's, they call it mosh pit, and mosh pit is pretty mild compared to what people started with in slam dancing, and the idea was you were just running into each other and, you know, doing kung fu kicks and stuff, but it was all big time wrestling. From the outside, it looked, these people are doing ridiculously dangerous and horrible things, and but it was really just theater. You get in there, and nobody actually wants to kick anybody else in the face because that guy's going to come back and kick them in the stomach, you know? So there was this one moment where a dude jumped and, you know, was going to do crowd surfing, which is a really bad idea because there wasn't a crowd. There was just only a handful. And so I turned around and looked up, and, you know, his foot comes right in my face. And that's actually why I got this bump on my nose. Yeah.
Huh.
So funny story there. Anyway, so I know I catch this foot in my face, and I go down. And there's enough people, it's not like there was nobody. There was enough people that were nearby, but there wasn't enough to actually hold this guy up. And so, you know, he comes down, breaking his fall from my nose, and I, you know, a little disoriented. And all of a sudden, 3 or 4 people all around me who have been at that moment, you know, elbowing each other and punching and jumping and kicking and, you know, banging into each other really hard, all of a sudden stop what they're doing and pick me up and carefully, even sort of like while they're slam dancing, they're like moving me through the crowd to the back of the crowd so that I can get to safety. So in the middle of all of this mosh pitting, not called that then, but then we got to then I got to safety, and I just marveled at that. I came out there, and actually there was this old dude with his ZZ Top beard, arms folded, like, what is going on here in this young crowd? And it was funny, but so I'm standing there looking around, and I'm like, I thought this was a dangerous place. I thought when I went down that, you know, I was going to come home with broken bones and lacerations on my face and that kind of stuff. And you could say, well, you got a bump that lasted your nose, lasted all your life. Maybe. Who knows? Maybe it was just genetic and it just showed up at that time. That sounds funny, but look at my family pictures. You'll see what I mean. Anyway, the thing is that behavior wasn't predictable. I couldn't have said, look, it's a crazy, chaotic, massive place, and I know how they're going to behave. If I go in there and I get kicked around, they're going to continue kicking, and that's going to be dangerous. Or could I have said, oh, no, I'll go in there, and if I get hurt, you know, everybody will calmly move me to a safe space. I couldn't have predicted that either, right? So the market is weird that way. It's like, who happens to want to run to safety? Who happens to want to panic? Who happens to want to buy up when you want to sell out? You don't really have that kind of level of predictability. And yet, there are times where people do things that, well, you know, a company sells way off, and people are like, That's ridiculous. I mean, whoever panicked out, it's just a good deal. Let's go ahead and buy in, right? And then there's the other side of it. It's like, it might be a good deal to hold on to, but we have better opportunities. We have to get out now so we can take advantage of these other opportunities. People are going to look at us and say, yeah, well, you're panic selling out of fear. Yeah, but you don't know what opportunity we have going on here. And so we're just doing this, right? So market behavior looks irrational when you don't have the explanations of the human actors behind. But in fact, market behavior is much more rational than you imagine, and still less predictable because all of the conflicting movements that do occur. So the markets are not random, and yet, I mean, not fully random, and yet it's a bad assumption. It is a myth to assume that they are not and trade that way. If you plan that the market is random, and you plan your trades around that, your rules and your thinking, your expectations, then you do a much better job because you will protect your risk. You will not assume that you can load up a position with the hope that, well, this time I know, right? So, well, wait, the market, I have to assume the market is random. So I'm going to start with that. I'm not going to load the boat because the market might do what I don't predict, right? So I just, the myth that the market is not random, that there's some amount of predictability, is an account killer myth if you trade heavily on that idea.
And so that's one of the reasons why I wanted to actually, that's one of the reasons I wanted this to be one of the myths that we talk about, because I've had this same discussion with Gordon in the past where, it's something that may seem obvious, maybe it doesn't, but it's something that none of us ever really give a whole lot of thought to. The fact that the markets are random in a sense that they can move in ways that you cannot predict, and yet there is this machine of sorts that's moving it. So just because we can understand some of the moves that are being made, or just because we can predict some of the time what the market will do or what it might do, it doesn't mean that we have a full understanding of how the market moves and where it's going to move, or that it's not actually random, because you know what, it is kind of random, especially in maybe not especially, but in Forex it seems like that's a big a big thing, is that it's super random, because there are so many things that influence what happens in the Forex market. And just because you see the euro going up against the dollar, then you see the euro going down against something else. And so it's, I don't know. But regardless, that's why I wanted it to come up, because it's a good explanation of a concept that we don't really give a whole lot of thought to most of the time. So that brings us to myth 2, though.
So let's see. I'm trying to make sure I phrase this right. Myth number 2, the markets are predictable or are not predictable?
Are not predictable, because
yeah,
okay, so myth number 1,
markets are not predictable is myth number 2.
Yeah,
that is a myth, that they're not predictable. Now, yet we just said, wait, but the markets are you just said the markets are random. How could they be predictable? Again, there's that gray area, and both of these myths kind of come at the same direction, right?
Yeah. So I mean they almost present contrary views of opinion, where we say the market is random, but then we say the market is predictable. Well, you know what? I have an example from injuries I've had too. So think of it this way: we all can assume that we would react in a specific way during a crisis, right? Like you can assume that you go down in a mosh pit and you pretty much don't come out of it without severe injuries or needing to go to the hospital. But we can all assume that we would react in certain ways during certain things, like the theater being on fire. We can all say, well, I wouldn't panic, or we could say, oh, dude, I'd be all over the place. And yet, the person who normally is saying, dude, I'd be all over the place, is a lot of times the person who ends up being the cool head, the So, anyways, so when I had my accident with the table saw and I cut off my finger, I don't know if you can see that or not, but it's missing half the index finger. When I had that accident, I had never in a million years thought that I was going to cut off fingers with a table saw. I had been doing construction for a long time, and I may not be very old, but I've been doing construction since I was 9, and this was when I was 17. So I had never had an accident that was a serious injury. I had a lot of cuts and stuff, but nothing cutting off fingers related. So when this happened, it was something I never even thought was going to happen. And I always figured I'd be the one who would panic. Like, oh my gosh, my finger is on the floor. How am I going to fix this? Like, how is this going to be fixed? Yeah. And yet, right when it happened, my hand went up in the air and I brought it back around and I looked. I was like, Dad, we need to go to the emergency room right now. And then I looked over at my friend who happened to be there too. He was across the room. I was like, Adam, I need paper towels. And so he comes over and he gives me one paper towel. I was like, Adam, I need more paper towels. And so he runs back and he grabs a whole roll of paper towels, and then I just wrap my hand in it, and my dad takes me to the emergency room, and I made some inappropriate jokes with the nurses. I thought it was kind of fun, actually, but it was traumatic, and yet I was able to stay calm during all of this, and it made me realize that I'm not nearly as panicky as I thought. I thought I was the panicky one, but turns out I was a lot more level-headed. But that's the thing. We may not be able to predict what's going to happen, but at the same time, we can predict some of the time, and we can see certain things happening. I don't know.
Yeah. So it's a myth that the markets are absolutely not predictable, that you can't predict anything. There are some things you can predict. You cannot predict with pure certainty. Typically, you can't predict with pure certainty all the time, for sure. Even if you get one or two calls right, you're never going to get them all right. But that doesn't mean you're never going to get anything right, and it's not predictable, because by its nature, if that were true, then you could always be predicting the reverse and get it right. You know, so it's the markets live in this space between fully random and fully predictable, and they're closer to random than they are to predictable. But there are some predictable elements. Usually, you can predict a direction or an intensity, but not necessarily both. Right? Option market makers absolutely make their living predicting intensity, but not direction. And they know how to be right 70% of the time. The intensity is this level or less. So if the markets were not at least somewhat predictable in some factors, then there wouldn't be markets, because you wouldn't have market makers or options market makers or risk providers or anything like that that make the markets run on a day-to-day basis. You would literally have a barter system. You'd be bartering US dollars and stock shares and hoping you could find people who all just had a coincidence of wants. I want to sell these shares. I want to buy those shares. I have the country currency that you're looking for, right? I mean, and it's not as though it couldn't be done that way. It could be. I mean, maybe in the, if you think about it, in the 1700s when they were just trading shares of cargo ships, it was kind of that way, but it's a lot less efficient, and there's a lot more price fluctuation. It would be kind of like what you have in the housing market even today. The housing market has got more and more efficient, but it's still an illiquid market. You have your house. How many people out there actually want to buy it? Well, it's a lot less than 1,000. If 1,000 people come look at it, maybe 3 people are going to make an offer, and if it's a hot market, maybe 5, right? If you have 5 people making an offer or 3 people making an offer, wonderful. But if it's not a hot market, you could wait months for the one person to make an offer, and that offer is not the offer you want, and you have that huge price differential. Right? That's the characteristic of illiquid markets. Liquid markets happen in our modern day stock market entirely because you've got people who really want to trade in at least somewhat predictable ways. And when I mean predictable, I mean within a range. You don't have people that I own the $65 stock, but if something were to happen, I would be willing to sell it for 1 penny in a second. I mean, And then, well, I'm going to wait around until this stock sells for 1 penny, and then I'll buy it, right? So in the past 10 years, let's go there, that has happened once out of all stocks. And that was the flash crash when Accenture dropped down to, or was it Procter & Gamble? No, I think it was Accenture. It dropped all the way to 1 penny, and somebody actually got that order. And I believe that the market, the NASDAQ or the Dow or the New York Stock Exchange, somebody, the exchange involved came along and broke the trade. They said, no, that's, we can't accept that, right? So you don't have truly random behaviors in the market. They're not even allowed. And so it's not true that the markets are completely unpredictable. The Swiss National Bank a few years ago, right? We have unlimited amounts of money that we are willing to defend our floor against the euro, 1.2, right? And literally they were saying we will print whatever money is necessary in order to make sure the Swiss franc always remains at least 1.2 euros or better. And so they went that way for 3.5 years. Now, you couldn't predict when they were going to break. You could have predicted they're going to break, right? you could have predicted that because there was way too much. In hindsight, you would not be able to predict when, and because you couldn't predict when, you couldn't predict the intensity. The intensity that occurred, people talk about it's like a 45 sigma event, statistically speaking. So it was a ridiculously huge move. And then all of a sudden it came most of the way back in very short order. And so the idea that, well, there's that trade, and I'm going to wait 3.5 years, I'm going to sit around, and you can't get that. But what you could get is the fact that between now and whenever they do break, every time we get down to 1.2, I could probably buy. Or if we get too far away from 1.2, I could sell, and it'll come down to 1.2 where I can take my profit. Right. So that little system of the Swiss and Euro comparison yielded 3 years of opportunity for people that had that one factor that was predictable. Right.
Yeah.
And those kinds of things are going on all the time. In fact, every major valuation that analysts make about a particular company, oh, here's the price valuation they should be at. It's that same thing. It's like, well, this is what the company is really worth. Great. So you can predict that people will react as the price gets far away from that or far above that or whatever. So there are these factors that are absolutely predictable to the extent that you can clearly and cleanly profit from them. It gets more tricky. It's all about risk management and judgment and so forth. But it is a myth to say, well, the markets are completely not predictable, so I'm only going to trade systems where I assume random behavior. Well, if you did that, you wouldn't trade because you would see that there were no opportunities. And the weird thing about it is, if you tried to trade that way, you won't win because there are people that are trading against that very belief.
Yeah.
So that's myth number 2.
Yeah, that was myth number 2, which we took a little bit longer on myth number 2 than.
So much for succinctness.
Yeah. But the rest of these, no, they won't. They still won't be succinct, I don't think.
Hopefully they'll be interesting.
We're going to give it a shot, though. Yeah. Trevor Keel says hello. So hello.
Hey, Trevor.
Yeah, he actually chatted. If you want to chat with us, you are more than welcome to get on the live stream app, or you can chat directly from the little window. I don't know, little blurb thingy that shows a chat box that comes down. You can chat as a guest. You don't have to register for anything. You can just conversation bubble. There you go. See, I've been saying I've been trying to come up with that word for the past several weeks, and now you come up with it. So it's conversation bubble. Conversation bubble. So, anyways, you can also chat with us. You can also send us a text message, as you can see on the little thing down here at the bottom of the screen. Which I don't know how to. Wait, there we go. Right there.
Oh, a little server.
Look at that. All right, yeah. Right down there is a phone number. You can call or text that number. It comes straight through to the broadcast. We'd love to hear from you. But for right now, let's just go to, number 3?
Number 3, yes. Oh, by the way, before we run to this, since Trevor's listening, Trevor, chat in if you have your own version of those first 2 myths or your own take on whether or not those are actually myths or not. Would love to hear your. For those of you that don't know, Trevor is a longtime user of one or more of Wes's bots and has had some success with them. So we like Trevor. Meanwhile,
we don't like him because he's had success with it. We like him because he's awesome.
Yeah, we like
but
him
also
because
he has been doing pretty good with
because he is awesome.
Yeah.
You're right. You're right. So all right, this one, myth number 3: there's only one right way to trade, or given any indicator, there's only one right way to read it and to use particular nuances to interpret it and interpret it correctly. And when you do that, then you get this fully predictable outcome.
Yeah.
And that is a big account killing myth.
Yeah. And anyone who's known me for any longer than about 5 minutes knows that I'm a big opponent of people saying that this is the one way to trade. Even people who say that robotic trading is the only way to trade. That's the only way that I really trade is using robots. And I'm transitioning, to doing a little bit of discretionary trading as well and market analysis and everything. But most of my trading is done by robots. So, you would think that I would say robot trading, that is the way to go. But that anyone who sticks with or is so rigid about thinking that Elliott wave is the only way to trade, or Bollinger Bands used this way with a 1.26 the standard deviation, and anyone who gets so dead set on one thing or says that this is the way to trade and everybody else is wrong, and that may sound kind of stupid. You may be thinking, well, no one actually thinks that. Oh yeah, they do. There are a lot of people who think that there is one way to do something, or one way to trade, one way to use this particular system or whatever else, and that is the only way. Anyone else is just going to lose money in the markets.
Yeah. So as an example, I think the kind of thing that I hear more frequently along these lines is something like, suppose you see a candlestick pattern, a Japanese candlestick pattern, and you say, you look at this and say, well, it's a bearish engulfing. And somebody else looks at it and says, no, it's not a bearish engulfing because the range only engulfs the body. The body range only engulfs the previous body. The total range does not engulf the total range of the previous candle. And if you read it exactly right, then it does what you expect. And if you don't, well, then you're not going to get any difference. So that kind of thinking is, the best you can do is say, well, I've done studies, back testing, forward testing, modeling, whatever, and the statistics on this particular way and that particular way have this much variation. This one's 58% right under the following conditions. This one is 60% right under the same conditions, but it has this other variation to it that occurs rarely. Right. So, I mean, that's the kind of report that I would expect from somebody who actually did the hard work of looking through the data and coming up with the truth of the matter, at least, closest available observable truth in recent history. Right.
Yeah.
So that's what I would expect. If instead what I hear coming out of people's mouth is, oh, well, you have to read it this way, otherwise it doesn't work. It's like, okay. You probably have experienced this at best 25 times in your life, and you're making a judgment call out of what you can and can't remember accurately in those 25 times. I mean, that's what we do as humans, and 25 is being generous because, that old psychology fact, your short-term memory keeps in place 7 plus or minus 2 items, You might have experienced it 25 times, but you're only thinking of 7, and you're selecting a certain 7 plus or minus 2, and oftentimes it's minus. So you got 5 good trades. You're like, I know this is the way to do it, right? And that's what I experience a lot. And again, one of the favorite things I would experience with my students who I'd coach is that I would do that. I would accidentally catch myself doing that when I would be telling people, no, you really can't expect to make any profit by trading in this particular method because blah, 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 and some belief that I had. And then a few weeks later, they come back and they're having success doing exactly the thing I said they couldn't have any success doing. I'd be like, what? Wait, I got to, and so then I would look deeper and I realized, oh, I was my assumptions were faulty because I didn't have enough information, or I didn't have the strength of information I thought I did. And so, I always loved learning through that experience. One of my least favorite things coaching people was the opposite, right? It was that when I'd say, so this assumption you're making, they'd look at this, look at this chart. Every time you buy a dip, for sure, it's going to go higher. Like, yeah, just because it has in the past doesn't mean it's going to happen in the future. Yeah, but if I take your point of view, I'll miss out because it goes up and it's going to be great. So yeah, I get that. I'm not saying it can't go up. I'm just saying that's not a provable rationale for why you should be buying the system. You can't, and I try to have that discussion, and after 3 or 4 times, I'd be like, okay. So you know what you need to do? You're right. You need to make that trade. And then the next week I come back and they'd be interested in talking about something else, and then I knew that they had made that trade and lost a lot of money, and they didn't want to talk about it anymore. So that was my least favorite thing, because I don't like seeing people stick to their beliefs that I know are ineffective beliefs, only to have the bad outcome that I predicted for them come true. And so the idea is thinking that there's only one right way to trade is saying there's a limit to what's possible out there, and I know what that limit is. Okay, there are limits in the market. You're not going to see a stock go from 1 penny to 10,000, and you're not going to see a stock go from 10,000 to 1 penny all in a single trade. Functionally, that's not going to happen. And what you are going to see is a lot of in between. but if you try to start bringing those limits in, you better have some really good information about what the limits are. So if you start saying, well, this is so unlikely to happen, or this can't happen, then unless you have a rigorous amount of research and information and observations to know for sure that what you're basing your belief on is worth keeping, then it's better just to say, okay, well, I'm willing to go on that assumption, but if I'm wrong, then what? And sort of plan your trading around that. If you're wrong, what could happen is so bad to your account, the answer is you don't do it with money. You paper trade it. If you say, well, if I'm wrong, I'm going to be out 3%. As much as I don't want to lose 3% of my money, that's not going to ruffle me. I can live to trade another day. I'll go on. Great. Okay. Proceed. Give it a try. So anyway, that's just, there's only one right way to trade is a very questionable belief.
All right. Myth number 4. The entry is what makes you most of your money in trading. And actually, this was one of the questions I asked in the assessment for the Trader Continuum. So when you join the Trader Continuum, there's an assessment that you can take. It asks a series of questions through the middle section. It talks about, asks basic things like, or it says basically,
wow.
Whoa. Okay. We're still streaming, so that's fine.
Okay. Phew.
Okay. Well, man, yeah, that was a little weird. All right, so
we were blinking out.
Yeah, that would be unfortunate. So, anyways, I asked questions that were true or false questions, like my broker is working against me, true or false, or but this was one of the questions was the entry is what makes most of the money in trading, and true or false, and so
one of my favorite stories or scenarios to sort of question people with is to help them really understand the fallacy of that belief is, imagine you and I made a trade and we were convinced in opposite directions on the trade. I said, I'm sure based on my predictions this price is going higher, and in fact I'll say it's going this much higher in this time frame, and your belief was no, it's going lower during that same time frame. And so we had these opposite beliefs, and so we're happy to make the trade because of the opposite beliefs. Now imagine that I said, okay, my reasoning is superior, clearly, so we know that I'm going to win. You may as well hand over the money right now. Just go ahead. Just give me $500 because that's what I'm going to make in this trade because my entry was superior. My entry was clearly the right choice. Now, you may not believe that, but I can prove it, or it will prove out over time. Doesn't matter. It's inevitable. You may as well give me the money now. if I were to say something like that, would you go along with me? Would you say, oh, you're right, I'll write the check, here you go, $500. I mean, if you would, then I should take that tack more often. But no, nobody would behave that way. Nobody would just fork over the money for a wide variety of reasons. But most importantly, because it's just simply not true. And because that's not true, because you wouldn't fork over the money because the person on the other side of your trade had superior reasoning, then you should similarly not expect yourself to have made money just because you bought at the right time. And yet, the majority of traders spend the majority of their time trying to do exactly that. When is the right time to get in? Because if I get in, that great trade will just take care of everything else. Now, having said all that, I spend a lot of time looking at good entries. I like doing that. But I know that a good entry is, if I get a 5% advantage out of that entry, that is gold. But think about it, 5% is 1 out of 20, I mean, that's all I need is 1 out of 20 trades to go my way predictably, above random. If I get 1 out of trades that goes my way more often than strictly random, I can make money with that system. And that sounds like such a tiny statistical edge, and yet it's a very, very strong edge if you know how to work with it, right? So the big question of why you're spending so much time making entry is connected to how it fits with everything else. Are you keeping your risk the same? What kind of exits are you doing? What kind of market conditions? How frequently does it come along? All of these other things are important elements without which you can't ever expect to make money regardless of where your entry is. But assuming you have all these in place, then that entry becomes really important. It's kind of like the price of oil. So Saudi Arabia does not produce the majority of the world's oil, but they produce a certain amount, which is a key amount, and they control a distribution channel, the Persian Gulf and a few other areas there, that is key. And so how much they produce or don't produce, and how much OPEC in general allows all of the oil producing nations to produce and not produce, is this key differentiator of the price of oil. And it's kind of that way. The entry is a key differentiator, but it is not the only differentiator, and it is certainly not the kind of thing that you should spend most of your time on. You should spend most of your time on everything else.
Yeah. So it's more like a trick question. Like, is the entry the most important part? Well, no, because it's part of a big whole. It's not even necessarily the most important part. It's just a part of a very massive whole, which is trading system. So, and actually, I think the last one kind of has to do with that just a little bit as well. You can be a successful trader only if you win more often than you lose.
Biggest myth of all, I think. Most often misunderstood principle in trading. Myth number 5, you have to win more often. And the more you win, the more successful you or your system of trading is. That's, I mean, have you ever worked with anybody while they're back testing and, comes up with whatever result and they're like, well, maybe if we change this to see if the win percentage increases.
Yeah.
So that's the instinct. What do we do to get that winning percentage up? And in some cases, you almost want to actually be going the very opposite. So a guy by the name of Ned Davis, if that name's not familiar to you, he's probably the most successful researcher, investing and trading researcher in the history of modern markets. When I say most successful, I mean he's made the most money selling his research. Got something like $250 million when he sold his company, and it's just research. It's not even doing the trading. So anyway, he created a very successful company called Ned Davis Research. And I happened to be there when he was giving his speech just after he'd sold his business, and sort of, it was the actual Lifetime Achievement Award for the CMT Association, and so we were honoring him for all of his contribution to the research business and financial research. And he told these stories. And he said, look at this. And he showed this chart of a methodology based on the RSI indicator that won 73% of the time. And that wasn't, based on exits. That was just, buy and hold for 20 days. So it was it was unimaginably wonderful for the kind of people that love to win more often. Like, buy this, don't sell it for at least 5 days, sell it 20 days later, 73% of the time you win the trade. Sounds great, right? Over time, that trading system lost money, like double digits on an annual basis. And then there was another system that was just based on simple moving average. Here's the 200-day moving average, and here's the 50-day moving average, or something like that. It wasn't the 250. Anyway, it was a simple moving average system. If the price crosses, you're in. If the price crosses back, you're out. You're not just out. You're flipped over, going short the other way. That system outperformed buy and hold, which was stunning. But it was right only 47% of the time, because there were a lot of whipsaws. There were these periods of time where the market would kind of flatten out, and the moving average would go right through the middle of it. You'd be in, be out, be in, be out. And so you have this string of losers, have maybe 12 losers in a row. And then all of a sudden it would take off and go whatever direction it was going to go. And sometimes it would go up and sometimes it would go down. But he said that crazy little system, the thing about it is it puts you in every single major move. You have this big run up. We go from, $50 to $200. You're in it. You're in it most of the way. You drop from $200 down to $120. You're in it because you're short, and all these little whipsaws back and forth. And I saw that early on in my days when I was trading as a prop trader. That even in intraday data, you could find IBM was famous for moving away from its moving average at the time, and there was a very wonderful system that you could trade based on that idea. The problem was entirely what happens when you go flat and the markets get kind of quiet, and you're having to put up with those whipsaws, right? So what he showed was that the markets outperform. I mean, this technical system, entirely technical system, outperformed buy and hold over many years in bear and bull markets alike, and it was not winning more than 50% of the time. So it's counterintuitive. Most people want to see something win, but that pushes you towards systems that have big risk, and you usually can't be comfortable in overcoming the drawdowns. Now, that being said, high percentage winning systems are actually my favorite kinds of systems. So I might be sounding like I'm arguing against the very thing I try to create. It's not that. It's that you have to have a special kind of risk management and opportunity management when you do trade those ways. But that simple assumption of if I win more, I will do better is not a valid assumption.
I'm hoping that everyone has been able to see everything that we've been talking about and hear everything we've been talking about, because the live stream had a weird hiccup, and I don't know if it continued broadcasting or not, so we'll just hope for the best. No one has said anything, to the contrary. So
but maybe they haven't been able to.
Well, yeah, maybe. I don't know. Anyways, okay. So I actually had some comments about that.
Oh, let's hear
the higher win percentage and stuff like that, because I've back tested hundreds of systems using very accurate data, and I've back tested these systems across multiple platforms, not just MetaTrader 4, but also TradingView. Also, I've seen the back testing results for TradeStation and stuff like that, and some of the best systems I've seen have had actually pretty low winning percentages, and that's because and when you get right down to it with a robotic system, one that follows very specific rules, the best way to make, I hate to say the most money, but one of the best ways to make a high amount of money is to follow the trend, right? I mean, we all kind of know that already. But how do you follow a trend? You don't actually know when a trend is starting. So if you don't know when a trend is starting, how are you supposed to get in on a trend? Well, the answer is you lose a lot, and then you win big. on a trend if you're following the right system. Like that's, don't just go place a whole bunch of trades hoping that it's going to, eventually turn into a trend. But if you're following a good enough system, you can lose a lot. One of my friends, his name is Scott Welsh. He had me program a couple of robotic trading systems for him, and they're based on the Turtle Traders. You can even go look up Scott Welsh if you want. You can buy his robots if you'd like. But so what they were based on was the idea that you would lose a whole bunch, and sometimes it would be pretty crushing, where you'd feel the weight of all these losses, but then you'd get this huge gain. And the losses were relatively small and everything. It wasn't too complex or whatever, but it was a pretty cool system. And but the counter trend systems, what a lot of people have come to refer to as rollover methods, where you hold a trade and then you place trades as it's going against you to move your way back up again, whether in a grid or whether based on the same system. And you just never stop out. You just continually just let it sit there for a long time. Those systems have extremely high win percentages, like big time high win percentages. We're talking like 90 to 95% winners, because the only losers you get are when that first trade exits out at this little tiny loss and that second trade wins like this. But that's not always the case. Sometimes you get into that first trade, then you get that second trade, and you're thinking, we're going to do this thing, and then you lose your account. Or you draw down by 50%, and you're just still sitting there watching this as it's going against you. Pretty helpless, because at this point, you exit out, you lost 50% of your account. Yeah. So, but one of the examples of a system with a low win percentage, let's see, profit trades 43%. It's a 43%. The handyman robot, I'll show you guys this because this is kind of funny actually. Let me see where my screen is. It's supposed to be, oh yeah. Okay, give me 1 second while I adjust this to the screen that I'm actually on right now. I'm gonna drag this over here. There we go. All right, this is better. Okay, so if we look at this, and it's an ultra-wide monitor, so I understand it probably looks a little bit small, but the handyman robot is actually a 44% win percentage. 44% of the trades actually won. And yet, total net profit for 3 years? 3 years? Yeah. 15, 16, 17. Yeah, for 3 years. A little over 3 years, $34,340 on a $10,000 trading account. So it only wins 44% of the time, but it made 343% in a little over 3 years. And that's not a way to sell the handyman robot. It's not actually for sale. You can't actually buy the handyman robot. So, but it's I mean, it used to be for sale, but it's not for sale anymore. But there's, anyways. 44%. That's not a very good win percentage, yeah. And yet
it's made up for by the fact that your average win size is larger than your average loss size, and that's the kind of thing. So you have to make this trade-off. You have to make a trade-off when you create a system or follow a system. You got to understand the system's behavior. The trade-off is I get to win a lot. I get to win more frequently, but they're smaller wins. Or I can win less frequently and I can get bigger wins. Baseball analogy, singles, home runs. Take your pick, one or the other. You cannot become Babe Ruth, the home run king, if you're shooting for singles all the time, right? I don't know a good baseball player that was really famous for just getting on base. I don't know, Mickey Mantle? No, not Mickey Mantle. Lou Gehrig? I don't know. So somebody, one of these guys way back when was just... no, Joe DiMaggio. That's who I'm thinking of. He might have been a guy whose stats were that he could make singles, doubles, and so forth, and just get on base. Whereas the sluggers, those are the names you remember, right? Even more recently, A-Rod, Aaron Rodriguez, before he left the game, he held the 1, 2, 5, whatever recent number of years home run total record. But he also was like number top 5, I can't remember, in the number of strikeouts for the year. And so it's like, it's all over again. It's Babe Ruth all over again. It's like the guy's swinging for the fences. He's losing most of the time. And when he hits these home runs, it pays off, you know. And so you have to look at your system that way. If you don't like baseball or if you don't know the game, it's all right. I'm sure you can come up with some other kinds of analogies. But that trade-off is very real. And if you understand how linear that trade-off is, that in other words, you literally start decreasing your win percentage size, you increase your win size. The winning percentage and the winning size are just inversely correlated. And when you realize how true that is, then you can actually start designing your own systems. Or if you're not into that kind of thing, you can listen to somebody trade and say, I get that. Your kind of system should give me a lot of singles. But if that's true, then that means there's going to be big losers somewhere along the way. So where is it? What are you not telling me? Or the other way around, oh, wow, that system makes a really big winners. I can see how that would happen. But it probably doesn't win most of the time. You're telling me it wins better than 50% and makes these incredible, I risk this much, I get 3 times or more as much on average. Okay, that's probably BS. And if it's not, why are you selling it to me, right? So you have to kind of look at both of those things. Now, I, as someone who likes to develop systems and try to sell them to other people, I try to be very clear about that data. And if I have something where I say this is going to win a lot and it's going to win more, the win size is going to be more than your risk. I'm making a kind of holy grail type claim. I better be able to back that up. I better have the data to show you how that's going to happen. Hopefully, I haven't ever done that. I recently just helped another organization create a course in penny stocks, and when I did, it was very clear that look, you won't win most of the time when you're doing this, following this particular methodology. In fact, anything you do with a trailing stop is a home run style system. You will win less than 50% of the time. If you're using a trailing stop system and you're winning more than 50% of the time, then you're missing out on really big gains. There are some gains that you would have been able to just bank, and you're missing them, and you're probably making your system unprofitable simply because you're doing that. So, that's kind of thing. A trailing stop is the default for a trailing stop system is 36%. You should be winning at least 36%, and every percentage point higher than 36% that you win on a trailing stop system is a measure of success. If you can be in the 40s and have a trailing stop system, you've got a great system. And if you're not making money trailing that system, it's because you're mismanaging your risk and a few other things that are part of your system. So I'm a big fan of trailing stops and of trading that way, but I know that to do that, I have to expect that I'm going to have small loser, no problem. Small loser, no problem. Here comes the big winner. Sure enough, there it is. Yeah.
Awesome. Those are the 5 trading myths that could wreck your account, that will wreck your account, that will have wrecked accounts in the past. I don't even care what we name it anymore. It's just 5 myths about trading that we wanted to talk about because, quite frankly, these are some things that aren't covered very often in the variety of places that I've worked and the variety of places that I've become acquainted with over the years. These are things that are avoided pretty much like the plague. I mean, avoided as much as possible. What? Oh, yeah, sorry, it's a phone call. And that's not for Skype. That wasn't coming. Yeah. No, that wasn't.
Great, but
didn't just hang up on someone who was trying to call into the show. By the way.
Good.
Yeah. If you try and call into the show,
that's what I pointed out.
It'll come through on the computer. So, anyways, we've taken up an entire hour just talking about the 5 myths. So we will come back on Monday with another live broadcast, and we will have a newsletter going out this weekend.
Wait. Just one more thing. Would it be possible for me to show a chart and follow up on one of the trade ideas that we've talked about earlier in the past?
Yeah, absolutely. Go ahead, man. Yeah.
Okay.
Go ahead and bring it up.
So I just the timing is so good for being able to show this. Why is that not coming up?
Here.
Oh, it's up already. That's why. Timing is so good for being able to show this that I want to make people aware, because if you've been listening to me go on and on about, well, I haven't gone on and on.
Well, let's face it, you've gone on and on.
Okay.
Yeah, but it's okay.
If you've been listening over the past few weeks, you've probably heard me make mention of this particular trade, and we're getting really, really close to a time where this trade is going to become interesting. And this is GE. So can you see that?
Yeah, they can see it.
Okay, we're looking at the GE chart, and I talked about 3M and some others, but I wanted to give the big look there, and it's GE's come down from so far. GE is having such serious problems, and they aren't going away anytime soon. So I don't want to try to pretend that this is a stock that's going to just take off and return to its former glory days. There's all kinds of problems. That being said, what we have here is an unusual freak out on a stock that has already gone down a whole bunch. We've got this huge, not huge, we've got this very clear, distinct inverse head and shoulders pattern. I'm not a big believer that patterns predict the future. I am a big believer that patterns signal the possibility of a trend change. And so if that gives you a kind of an edge on how you're able to get into the markets because you identify a moment where trend change could occur, even if it gives you just a 5%, sorry, I'm having difficulty with this system. Okay, all right, I'm just going to have to hope you can see this. Right there at about 15.5 is the resistance level. We got close to that level, and we dropped it away. We also have this sort of sloping level that hits this one and has hit that one, and that one's interesting because let's see, I'm going to leave that one there, and then
Alt H. So if you press and hold Alt and then you press H, it's a horizontal line.
Yeah, okay, that's horizontal, but now I got to do the sloping thing, so that's what I've been doing wrong. Okay, there it is. Yeah. So you see this sloping line right through there is the trend. We broke that trend. We came back and kind of retested that same area, and we've gone up and gotten past it. If we change the slope of this line also so that it includes the most recent parts of that inverse head and shoulders, then we get a slope that looks a little bit more like, let's try that. And yeah, about there. See, and that's not even perfect, but oops. There we go. Sorry, I'm playing with the trackpad on a Macintosh, neither of which are native country for me. But all right, here we go. So look at what's happened. There's the inverse head and shoulders sloping line, and there's the most resistant price action. And this big drop 2 days ago occurred and sort of like wrecked the trade. Or I mean, that's what I think a lot of people are feeling about this. Is that it wrecked the trade, because here, big downward move, and then what were we thinking? A change of trend? Crazy. That's exactly the point. What is it that caused this big downward move? The CEO came along and said, our manufacturing business is going to struggle for a while. Horrors! Sell off 12% of the company. It's like, really? The stock dropped 70% already in the past 6 months. Did somebody not know that they were going to be having problems in their manufacturing business by now? So this is, in my opinion, just a crazy, heavy overreaction. Now, maybe I'm wrong. Maybe the problems are so much worse than everybody said already. Maybe GE is functionally bankrupt and has no way of coming out of bankruptcy already. I could be wrong about that. But that's probably an outlier case. GE is a highly scrutinized, highly audited, highly invested. Almost every major investment bank and hedge fund in the world has some position swirling around GE, and it's crazy not to think that that people don't want it to fail. You know, it's just like they'll people will come rushing in and buy this thing as soon as they think there's any hope of the ship getting righted, so to speak. All right. So that being said, this huge drop has created this big swing of volatility, and then we had this decrease of volatility the next day with no follow-on, simply saying, yeah, there was probably an overreaction. Now, I don't know if it's going to go up, but I'm kind of thinking that wherever it's going to go up, it's going to go up somewhere around here. And if, in fact, we just take the assumption that from where the price is now down to this low right here of about 1382, that's barely more than 50 cents a share. And so I actually put that trade on this morning thinking, okay, that's it. I can risk that much, and just getting back up to the resistance level is $1, but $1 gain before the trend and the fund even gets started. Imagine what happens past that. Talk about your risk a little to make a lot kind of trade, right? Well, you know, if this doesn't suit you of holding on for, you know, a couple of weeks, maybe a couple of months, if that's not your trading style, then sorry to waste your time. But if that's exactly the kind of thing you're looking at, you may not necessarily feel the need to jump in, and certainly don't do it because I said this is not a recommendation, educational purposes only here. You would be crazy to think that just because I did it, that it suits your account. Invalid assumption. Look closely to determine what your style is. There is, however, an opportunity that is worth looking at and educating yourself over to understand how to manage risk and prepare for opportunity. And GE is in a very critical position right now, a sort of moment of truth, if you will. Is it going to turn its trend and you know, make a long-term upward move? Slow, perhaps, but profitable if so. There we go. Just wanted to point out the GE trade.
Awesome. All right. In that case, we'll bring us back up, and then we can say goodbye. And actually, I just realized Monday is Memorial Day, so
Broadcast.
Yeah, we probably won't be doing a broadcast on Monday. Anyways, it's going to be good times regardless. We'll see you again on Tuesday. There will be a newsletter coming out this weekend, and we'll include some of the trades we've been placing, the market analysis we've been doing, all that cool stuff in the newsletter. So you can expect that in your inbox if you are signed up on the website. And if not, you should head over to tradercontinuum.com, and it will... you can subscribe to the newsletter. It's free. And other than that, I think that's it, man. Thanks for being here. And thank you for attending live. Have a fantastic weekend and a great Memorial Day. Thanks. And I guess goodbye for now.